So I think trust is always, it would be like reliability, delivering what you promise, length of relationship. So for example, the longer you're with someone, the better your trust. If you say, I'm going to hit $1 million of revenue this year, and you deliver $1 million of revenue this year.
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave.
Last week, we talked about how unicorns are a startup worth over $1 billion and how it's about $100 million revenue at a roughly a 10x software revenue to valuation multiple. And so what we talked about was that based on this count, we see that the United States and China are having a lot of unicorns, and there's a big debate about the rest of the world. So United Kingdom, the rest of Europe, EU, like Germany, as well as France and Switzerland and Sweden. Obviously, we're talking about Southeast Asia, where Singapore and Indonesia are emerging in terms of unicorn count. And this corresponds roughly to the market capitalization of these unicorns. So unicorns worth more money, so roughly the charts are roughly the same. And what the claim is that Asia Partners have written a report saying that this is the age of the Southeast Asian startup, that there's going to be a lot more unicorns that will emerge because of what we have seen happen in China and Japan and South Korea, but also USA and China. And so this is a great time to do so. I literally just met and had a meeting with an LP today, and his perspective was like, hey, I've invested in about 10 VC funds in Southeast Asia and they're all not performing. So he's like, maybe I shouldn't invest anymore into Southeast Asia VC. So that was a little bit because what we're talking about is the DPI, right? So he's been watching these startups grow for a while under the portcos of these VC funds. And from his perspective, those, even though we're waiting towards the end of the fund, they don't look likely to return cash at the end of the day, even though the book value is high. So we'll talk about this, but then the question that we had a debate about was, is this because of the fund is underperforming? Is he picking the wrong funds in Southeast Asia? Or is it Southeast Asia a problem? Or is it the right strategy within Southeast Asia that's a problem? So these are things that you all will also be doing your group work and simulating these VC funds. And a lot of people recently completed their AGMs last week because of F1. So, the LPs were in town, so they decided to hold their general meetings during this time period as well. And so what we saw was that in China, there were many IPOs. So a lot of people made a lot of money, USD denominated funds. And again, we talked about how fundamentally this was stacked by Asia Partners, roughly from bottom up. A nice way to think about it is foundational and fundamental technologies working its way up to the most service-oriented or the most consumer-oriented is based on fundamental technologies. And so the claim that Asia Partners has made and positioned is that in Southeast Asia, there are a lot of IPOs that are waiting to happen because they have not yet created these billion-dollar companies in the same developmental path, the same developmental fundamental infrastructure. And as a result, we have noticed this trend of time machine founders. So USA, Asian Americans travel back to China to build Chinese companies. Chinese companies are traveling to Singapore and Indonesia to build companies that they feel like they have an understanding because they've seen the future that's played out in those countries as well. And so we talked about how in general there are about 4 major clusters of unicorns of high value companies. We have Singapore regional. And so what we saw is that Grab is a great example where it's in Singapore, it's in Indonesia, it's in Vietnam. And then recently Gojek was only in Indonesia and in Vietnam. And so they were pushing for a regional story, but they recently withdrew from Vietnam because they have spent hundreds of millions of dollars and not getting much profit. In fact, they're still losing money in that business unit. So they call a spade, and then they exited. But guess what? Indonesia is big enough. If they can make Indonesia work, there is still a story for the Gojek story to continue. And then obviously we see that VNG Group, so is a classic example of a Vietnam company that is basically effectively a conglomerate with multiple arms across payments, gaming, etc. And they were recently raided by the Vietnamese police over the past 1 to 2 weeks. So we still don't know what's going on here. But basically, Vietnam, as of now, does not yet have unicorn go public because these are Vietnamese founded companies servicing the Vietnamese market, and then they have to do similar China style. They have to create a parallel structure in order to list in the US, and VNG was supposed to be the first and supposed to demonstrate that the Vietnam ecosystem can generate unicorns that can exit, and we will talk about exits as a process in terms of a management process in a future class. So Vietnam is as unproven yet as a public tech market, but of course we hear and met another VC who is focusing on early stage investments that are focusing on M&A or dividend plays. And then lastly, of course, the fourth cluster of unicorns that we have here is what I call virtual unicorns. So, we see a lot of crypto companies, we see a lot of other companies where the founders are based in Singapore, but they're just working from here and they are servicing maybe a global market or infrastructure play or whatever it is. And then basically what we said was that as a result, what has happened is that high interest rates have caused a global venture capital slowdown. And this happened across the US, this happened across the EU, China, and the whole rest of the world. So I think Southeast Asia's slowdown over the past few years is not a Southeast Asia issue only, it is a global issue and it's primarily being driven by one primary action, which is the US central bank and the US economy. And of course, we see this happening across all kinds of different asset classes. So we recently saw stock market rallies across Southeast Asia because US interest rates look like it's coming down. I'm not going to make it into a macroeconomics class right now, but basically people are like, there's a pickup opportunity because of currencies and blah, blah, blah. But the key thing to here is just that venture capital, as of today, is still very much driven by a lot of US capital in terms of LPs. And so we talked about how, even though there's a case, there's a slowdown, we still see that the total number of deals continue to grow regularly. And so we see this almost like you zoom out, even though there's ups and downs, we see the number of deals continue to go up, even though the total quantum has much more cyclicality. And the reason is because the core investment stack is still steady for the early stages, pre-seed, seed, Series A, but we see that there's a lot of swinging capital for Series B, Series C, Series D. So where are the Americans to come with their large dollar-denominated funds to do the growth rounds for our companies? So that's really kind of the question that people have. And so as a result, what we can see here is that your local funds in Southeast Asia that have been invested in by local high-net-worth individuals, but also maybe US institutional capital, they have continued to deploy. And so in terms of demand and supply, if you look at it, the valuations have not dropped tremendously because they're still active, they still have to deploy. But if you look at Series B and Series C, those valuations have dropped a lot because a lot of the supply of capital was primarily driven by funds that are based in the. And so as a result, because they're no longer really active in Southeast Asia, so we see a large drop in valuation because when you have lower supply, then demand continues to be the same, then the price goes up. In other words, the valuation goes down because you can get a larger ownership percentage with the same amount of check size. And so as a result, we talked about how top VC funds are really investing in about the 1% of the startups they see. So this is quite representative of a VC fund. In Southeast Asia, you're tracking 5,000 startups, you qualify them, you prioritize them, you do a deep dive where you actually do financial analysis on 100 of them, and then you present about 50 of them, so there's about one startup per week, and then you make sure you only make an investment in about 10 of them. So this is actually quite a common funnel, and actually if you look at Southeast Asia, this is actually probably not the best practice. If you look at global funds, for example, that are doing global deals, they will probably have AI bots, they will have lots of associates, analysts, and the entire job is to scrape. And I've worked with those data engineers. They scrape the internet, and then if you go on LinkedIn and if you type in, you change your status today to founder and the company is stealth, you will get an email from a VC probably tomorrow because there's a lot of bots that are all scraping, trying to figure out all these founders as they emerge. And so every great VC has to do this process, and we're kind of walking you through this process. But first, you have to source the companies. Then we talked about selecting those startups, but also getting into the startups. Then eventually in the next class, we'll talk about how startups fail and how VCs can support those startups as part of that portfolio management process. And then eventually how to exit as a company for each individual portco. And so as a result, sourcing deals is mission critical. You have to be able to see deals. You have to be attractive. And so as a result, we have to understand it because startups are aggressive. They move quickly, and the best founders move even more aggressively. Private information is private, and if you're smarter than everybody else, you're faster than everybody else, then you have an edge against other VCs where it's literally dog eat dog. And so as a result, VCs are always doing inbound marketing. So they do thought leadership, letters, LinkedIn. They also do outbound. They do emails. They will reach out to you. And also the difference between public information, which is comparables, multiples, who's out there, what's your LinkedIn, versus private information. How good is the founder? Is the idea good or not? What's your actual financial numbers this month? And so investors do refer deals to one another. So recently, this week, I got a VC recommended a startup to me, and I said, doesn't really look like a good fit for me. Let me refer it to this other person who does healthcare. So I think users have to be thoughtful about that, because then I'm not competitive, so therefore I'm not fighting on it. But yeah, there's lots of deals where I see a good deal and I'm not going to talk about it to my friends. So there's something to be thoughtful about. And so where we kind of left that off at is that VCs do judge based on 3 major metrics, and I think that's how you should think about it for your deal memo. In many ways, the metric that you should be looking at is this person a 10x team? Is this person a 10x product? Are there 10x defensible economics for this team? Now, somebody was asking me, is like, okay, Jeremy, what is the trade-off between, do you rather have 10x team or 10x product or 10x economics? I always tell people, it's like, at the end of the day, VCs are kind of like Olympics level team coaches. Their job is to source the best athletes, to select them, then to train them, and then help them win the gold medal. And so if you ask an Olympics athlete coach, for a swimming coach, for example, then you can imagine, right? It's like, okay, what do you look for in an Olympics athlete, in a swimmer? You'll be like, well, the person must be good at swimming, must be hardworking, right? And humble, and has the X factor. We can see the future where they can continue improving. We see a future ahead for them, for example, right? And then you ask the coach, for the Olympics gold athlete that they're trying to source and select and train, because you have a portfolio of swimmers to choose, which one's more important? Well, the Olympics athlete will say, I want all 3, right? So because no Olympics athlete is going to be like, this is not like junior varsity league, this is not like primary school, this is not my infant and toddler swim coach, right? Like where you teach anybody who pays you the money. Your job is to find winners, and so you want to find people who, as much as possible, hit all 3, right? So you can imagine a deal memo, you want to be like, this person is 10x team high, 10x product high, 10x economics high. That being said, I do have to acknowledge that in general, even though we look at 10x team, 10x product, 10x economics, probably team is probably first among equals. So I think you want a startup that's all 3, but if you had to pick 2 out of 3, I'd rather have a 10x team and 10x product rather than 10x economics, for example. And if you ask me which was the number 1 I'll probably pick the 10x team out of the 3, right? But I'm just saying that in terms of investments, some VCs have a strategy where they're going for companies that are obviously winners in all 3, right? 10x team, 10x product, 10x economics, I'm willing to pay top dollar, and I'm happy to be the number 1 bid, and we'll talk about it soon. And I'm willing to pay high because I believe there's definitely a price appreciation in this asset, right? Versus there are other VC funds that are not as competitive financially, don't have as much firepower, and so they have to look for the diamonds in the rough. The company may only have 1 out of these 3. So maybe it's high for 10x team, but they don't have a product, they don't have economics. So let's make the bet early before the other people come in to outbid me on this competition basis. So I think you just have to be thoughtful about this. I think these are 3 criteria. And if you look at Amazon today, obviously everybody will say Amazon today is 10x team, 10x product, 10x economics. But if you look at the first angel investor who made an investment in Jeff Bezos as a person, there was no product, there's no economics, there's only a business plan. So probably he was investing based on who we saw in Jeff Bezos. So I think this is kind of like what we need to be thinking about. And so I think one way to think about it is that this is a decision tree by a company called Next View Ventures, one of the VC funds that backed my last startup. And so they've created this chart. I'm not saying that this is the chart that everybody has, neither am I going to say it's this linear as well. But I would say that I think this is a nice way to at least try to systemize it. So for example, the GP is saying is like, hey, is this an exceptional founder? Is this a fantastic person? And if the answer is yes, which is on the left, then does this person know the market they're going after? Do they understand that founder market fit? And the answer is yes. Then they keep going yes. And then they're interested and keep meeting. The first coffee, the second coffee, they keep having coffees until the deal is made, right? But if, for example, it's a great founder, attractive market, because it's a good market to go after, but they're not really they're a great founder, but the market is not that attractive. But this is not just a exceptional founder, but this is like 1 out of like 10,000, right? This is like super duper. And then if it's yes, then get a second opinion from his other teammates, from research. And then if the other partners are like, not really that great, then go back to it. It's like, can we get more data, right? And then if they get more data, they keep going, right? So versus, is not an exceptional founder, it's not an attractive market, say no, right? And then there's some permutations that in between. But I think what I'm trying to say here is that this is a logic model. I think that many VCs, I think kind of like, I would say it's like 80-20, like this model is a pretty decent summary of how VCs would probably think about this process. But obviously, when a VC meets a founder, your brain is a neural net, right? So in the sense that you're probably processing all of this in parallel, right? So the first 1 minute, the first 5 minutes, the first half an hour, the first 1 hour, that meeting, you're probably processing all of these factors in parallel as a VC. So it's more of a pattern matching and intuition rather than a true linear logic model that you might expect more from a computer. So I think basically a VC probably walks away from a meeting and be like, at the end of the day, it'll just be like, I met you for coffee, and it's like, do I want to meet you again? Versus meeting somebody, other founder, versus talking to my LP, versus supporting my existing founder, versus hanging out with my kids. It's a stack rank, right? And then, so to some extent, this is the logical model, but there's an intuitive model, which is, do I want to keep meeting you versus do I want to stop meeting? So what you have to be aware of is that these heuristics are great, but they can become biases when unsupported by data, right? So for example, you as a VC, you have experience in healthcare, you're a healthcare founder, you're meeting healthcare startups, you can make those decisions faster versus if I am primarily a banker who became a fintech VC and now I'm meeting a healthcare financing play, then I kind of slow down, right? Does it make sense? Because I don't have the prior experience. But experience can also be biased, right? Because I think fintech's amazing and I'm totally crushing it. Healthcare has sucked for the past 5 years, so I don't care about healthcare. So the professional experience can be a crutch or it can actually be a handicap. Obviously, a lot of VCs some of them have won, so they have prior wins. And so they start the pattern match against that. So they're like, okay, Uber is a win, therefore I'm looking for the Uber for massage, the Uber for acupuncture, the Uber, so if you have a win, then you kind of keep going it. And so that prior win creates an anchoring, right? So it creates an anchor where everything else is like, I had that one company, and then you see those VCs, they keep talking about that one win they had all the time, and they can't break out that mental model. Yeah, so professional experience, right, just to clarify a little bit more is, so, the bad version of this is that, let's just say you're a consultant, you're also a consultant. I'm like, wow, you're so amazing. You talk exactly the way I want you to talk. Explain the business the way I think about the business. So similarity can be a bias, but it also can be a local bias. So for example, you'd be like, all my work experience is in Singapore. I'm meeting an Indonesian team. I don't understand the Indonesian team. And then instead of saying, I don't understand the Indonesian market and I should consult somebody, you say, this team sucks, right? And you see that a lot because people get biased by their local experience, right? And then lastly, of course, is your speed and info access. So VCs are highly competitive, and so they need to make decisions quick because they have many stories of the rabbit that got away, right? And so they need to move quickly. And also they have information access, so they kind of like they're grabbing information, and they may have to say yes before they say fully get the information. And so there's a lot of stories, for example, in Southeast Asian emerging markets, where VCs that have said yes to a team, they give a term sheet, and then they do due diligence and they find out that there's something bad about it. Maybe the founder fraud or accounting fraud or whatever it is. And those VCs end up pulling out of the deal. And of course, the tech news will report it as, this VC totally reneged on the term sheet. What bad form, it is. And I'm like, well, that's kind of true in the US. But, if a VC after due diligence says, and don't get me wrong, there are bad VCs that renege on deals. And so those are bad news. But a good VC should be able to say yes, but tranche the risk so that they're able to say no if they find more information that isn't likely to be, which is super irritating for the founders and the previous investors. But the bad thing is that if you're fighting for speed, you're working on partial information, guess what? You can be overloaded. So you kind of get overloaded, and then you just either say no because you're just too busy, and many stories will give you examples in the future. But literally, a Bessemer VC was like, he had 2 meetings to go for. He was double booked because his flight and everything got whatever. He had 2 companies that he had to go to. He couldn't make one of them, so he flipped a coin and he went for 1 meeting. And it turns out the other company was the one that became a billion-dollar company. I forgot the exact name, but I'll pull it out for you. So, great case study of a guy got overloaded, missed the deal, right? But also a lot of people become overconfident. So one of the big issues, and we talk about poker all the time, but sometimes you have to make information. I was watching this poker, Magnus Carlsen versus this other guy. The other, both are playing pretty bad hands. And then Magnus Carlsen wins the pot because the other guy all in. Blah, blah, blah. But what was interesting was that, kind of like what's in front of you. And I think a lot of VCs are very clear about what information they understand about a company. but they often are unable to incorporate the fact that they don't have sufficient information. So some people will look at, I have insufficient information about this deal, and some will say, I cannot do the deal because it's a bad deal. And some of them will say, I have insufficient information and it's a good deal. But the best VCs are able to say, I have insufficient data and my job is to get more data or acknowledge that I don't have that data to make that call. And I will make that call with partial or incomplete information. So I think that's actually a quite tricky piece, because what will happen is that, and there's some interesting research that I'll also share, but bad VCs will tend to be overconfident of their data, if that makes sense. So overestimate the information they have to make the right call. And so bad VCs not only miss good deals, but they tend to pick worse deals on average, right? So it's an interesting dynamic that you think about all the time. So VCs always have to be like, how do I maximize my win rate, my correct pick rate, but also how do I lower my bad move selection rate? So this is something that you have to think about for heuristic and biases, and that shows up. And so it comes up in the prism of many things. It comes in the context of socioeconomic class. It comes in the context of education. It comes out in the context of prior wins. It comes out in the context of professional experiences, gender, majority, minority. So it shows up in all these different angles that we have here. And so what is the result is that VCs have to assess, and it is often a sequential process in that sense. So they often meet the founders and they're making an assessment about the founders. Then they're making an assessment of the strategy, like does the approach make sense? So for example, I mentioned like this guy wants to put NFTs for concrete blocks. And I'm like, I didn't even see the pitch. I was like, that makes no intuitive sense to me. I have something else better to do with my time. I could be wrong, and he might be building a unicorn right now. But to me, I just said no, and I didn't look at the pitch. And then after that, but for other companies, I move forward into the pitch process to understand them selling me and giving me the data to make a final decision. That being said, great founders will often do it the other way around. So great founders will often prioritize traction, then trust, then pitch deck. So it's almost the other way around. So if you are a founder, you need to build a great business. And so rallying the right resources, building a great company, generating revenue, this is the stuff that is the really good stuff. Because the truth is, as a VC, I am paid to either look for, if I was only investing in deals that everybody was like super duper obvious that this guy is a great team, great traction, great pitch, then obviously, then what's my job? An AI can do my job, right? Because I just had to be like, wow, Sequoia's leading a deal. Okay, let me try to go into this deal. But you can't beat Sequoia because Sequoia has so much firepower. So you can't give a better price than Sequoia in terms of brand, differentiation, firepower. So the only way I can compete as a VC is I need to look for great founders who Sequoia is like, too much hair on the deal. This company is not ready yet for us. So I need to make a decision in it before. And so my job is, even if you are a founder and you have bad breath, horrible whatever, massive, like everybody's discriminating against you, but you're building a $10 to $20 million revenue business over the past 3 years with zero revenue, then I will get paid to find that deal. I will be rewarded to find a deal that's underpriced by the capital markets. And so I'm incentivized structurally to eliminate my biases as much as possible. So the best way is that founders should focus on building a company, right? And then the second thing that you do is they build trust. So a lot of them, you see a lot of like news. It's like, this is the pitch deck, they raised $20 million, blah, blah, blah. But actually a lot of it boils down to trust, right? Which is, and trust is a function of your professional reputation, your brand, personal brand in that sense, whether you have high integrity, low integrity. So if you are a great founder and you are excellent, but it's well known that you're low integrity, then no one's going to be like, wants to hang out with you, and nobody wants to fund you because they're worried about getting screwed by you down the road. So building trust is a really key piece, and I think it's an underrated piece. And I think the great founders that we'll talk about later often build that trust over the course of their professional work experience, their first investors, and then even as they execute the business, they continue building trust with their board and so forth. And lastly, of course, is the pitch deck, that is the encapsulation of strategy and all these other things, but the final packaging of the piece. So great founders really prioritize that in that sequence. And so what I'm trying to say here is that savvy founders, now what I talked about was the VCs who are selecting, but the truth is that we talked about founders that are priced, but the best founders who are not overpriced, but they're highly competitive, right? And the switch from this process to this can be a function of like a week a day, right? And there's so many stories, and I've seen it for myself, right? So I'll just use the public market examples. The best founders who are really good, or they have great traction, or they get priced by the market, or everybody kind of starts ending, they start kind of dogpile and they create an auction where there basically becomes a bidding war where multiple VCs are trying to come in. So for example, BenchSci, which is a small example, they received 5 term sheets in 3 weeks in that process. And one of the investors was the Gradient, which is Google's corporate venture capital AI fund. Later on in 2023, which was last year, they raised a $70 million check, new capital, Series D round. You just have to be aware that this is the kind of competition that can happen. And obviously, a more insane version of this is literally just happened earlier last year. But Rewind AI is basically this AI belief that we can create that your personal data, my computer, everybody should have a personal AI companion. So I shouldn't be using OpenAI. I should be using Rewind AI because I'm going to give them my computer, I'm going to give them my phone, I'm going to give them my life, I'm going to give them my memories. Everything about me should be in my personal, secure data locker to create a super AI that's Jeremy specific, right? Everybody has a totally separate AI model that's totally trained to them. And so this company raised Series A in 2023, they received 170 term sheets, okay? And basically, he was like, fuck it, let me create a Google form. And he says, submit me, please insert into this Google form your bid. Literally an auction, right? Because he was like, I'm in that good a position, right? Because the market's hot, he's a strong founder, he's got good play, the strategy kind of makes sense, you know what I mean? And so he just threw it out there. Imagine a Google form, everybody's doing research, he's like, okay, what number you want to put in, right? And so in the end, NEA, which is a very good fund, basically won the bid, or maybe they overpaid, but basically they bidded $12 million cash for a $350 million valuation. So basically this is only about 3% of ownership of this entire company. So it's kind of an interesting piece, but I think we have to be thoughtful about this process. So what I'm trying to say here is that and I've seen that for myself. So I was working at a company, I've been coaching this guy for 2 years, I'm helping him, and then he likes me a lot and blah, 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 and everything. And then I see the deal, I'm pushing the deal, but the deal is very slow on our side and everything. And then, I finally get across the finish line, but guess what? He also gets a term sheet from another tier 1 VC in Southeast Asia. And then suddenly I'm like, man, if my boss had let me make this deal 3 months ago or 1 month ago, I would have to compete against this guy, right? Does that make sense? But now I'm competing with this guy, and then now we have to talk about it, blah, blah, blah. And of course, the other bigger VC can spend more. So they can give him better financial terms. There's a slightly bit better brand name. So even though we're promising like, oh, we're better, we're more personal, blah, blah, blah. But that, that guy was like, you know what? I like you, Jeremy. I like but this guy's offering me more money, has a better brand name. So thank you very much. And then after that, I stopped talking to him for like 6 months because I was like so frustrated, right? You helped this guy for 2 years, and then suddenly you're like, peace out. You didn't get to win the deal, right? But of course, my learning from that is that if you're a VC and you're lead VC, you better make the decision fast, because the only way to have really won in that competition was give that term sheet like 1 month before, and then have a deadline for that term sheet of 1 week, and then so that this guy who was taking that pro time, but kudos to them. I mean, they move fast as well. So I'm not saying they're slow, but I'm just saying that this is the situation that we have. And so the savvy founders will try to do that. They try to put the slow VCs up front and they put the fast VCs a bit later. Yeah, does that make sense? Because they want everybody to come in at the same time to fight with each other, to have that bidding war. And so as a result, the great VC founders to pick. So I tell people, it's like, if you have 0 term sheet, you don't get a pick. If you only get 1 term sheet, you also don't get a pick. But if you get multiple term sheets, then you get a pick. So that's the game, that's the mandate for them. When I'm advising a founder, I say, get multiple term sheets to pick. As a VC on the other side, when my job is to get in before other people come in so that the founder doesn't get the pick. So these are 2 different plays, right? And so as a result, this is a survey of what are the factors for founders when partnering with a VC. Caveat upfront is, I think cash is number 1. The amount of cash and the valuation, I think still, and then maybe some of the control rights associated with that is still, I think, the number 1 pieces. But I do think that's pretty important. So founders will normally rate it as personal chemistry. Do I like the person or not? Or is the guy an asshole? Is this person going to add value to me because of experience in the piece? Are they fast or not in getting back to me? And then in terms of network, which is, can they add network? So there's that. Founders, VCs think like, oh, it's about the brand of the VC fund, which is different, right? So a VC fund, for example, the difference, for example, would be a VC would be like Open Space Ventures, for example, right? So Open Space Ventures is the brand of the whole VC versus personal chemistry will be saying, I care about personal chemistry with the GP called Hian Go or with the GP Shane Chesson, right? So this is the difference, right? So VCs tend to self-evaluate that brand is important. Then personal chemistry is number 2, so not that far off. Then 3 is speed, so they're quite agreed. And then everything else is pretty there. Length of relationship, yeah, so, turns out, I'm probably here at 2 years. Who cares if you have 2 years of relationship, right? I think synthesizing all of it, trying to give you a sense of the different factors, because all of you in your VC fund decks are talking about what differentiates your fund, what makes your fund good. Is it speed? Is it because you have a great team, GPs? Is it because you have great sector expertise? Because you understand the geography like Vietnam? Or because there are different plays that you have here. So you need to be aware that the different views. Point of view is, I think speed is number 1, if you ask me. Because if you have a deal term sheet now and it's exploding in 1 week versus theoretically term sheets in the future, I think speed is number 1. Obviously, don't be an asshole that people know you're a bad deal. So I think you have to be at least not shit. You have to be average or above average. But I don't think being a great VC comes in 3 months after everybody else is probably not the way. So I think speed is a big one. And then within the speed bucket, I think financials, the economic rights, and the economic value associated, the control rights effectively will probably be bundle number 2. Then number 3 probably be the individual relationship with the person. So that would be Jeremy's point of view, but it's very intuitive because I think the survey has its own issue because it's like people are remembering what happened to them in the past, etc. So I think that's going to be a key here. So on that note, that is the last questions. Let's start with Tun Lat. So yes, I think VCs do care about that quite a bit, but I would say it's a little bit down the road. So it's just like, are you a great founder? Does a great product happen? And then whatever. So for example, we built the companies together and everything, and then we were looking at Perplexity, which is, some of you are using Perplexity, which is a AI search engine. And so we were like discussing, should we buy secondaries this company? Because we both actually really like the product. So we think it's a great team, we think it's a great product, but we did actually spend a lot of time debating, which is Google can integrate AI into Google engine, and they have Android. Right? And then Apple is quite slow with AI, but they have Safari and they have the Apple device. So we're kind of saying like they're going to embed it directly natively into the hardware so that you don't go through the extra step, right? You don't download the Perplexity app like me, and then you go into the Perplexity app to search when Apples can try to do one step beforehand. So there's a bit of a debate, which is, do they actually have a moat or not? And I think for him and I, we said no. For this current price of the secondary, we don't think there's value. So we said no to doing the deal. And I feel like this is one of those deals that I might regret. But, I just said, but also I said there's other information I don't know. There's a lot of information I don't know. So I said, I don't know. I don't have too much incomplete information to make a decision on this part. So better for me to say no than to say yes. But yes, I think a lot of VCs will consider competitive mode for that. There are a lot of companies today that are now no-brainers for people, right? And so because of the competition to get into these no-brainer deals, people can get aggressive in bidding and counter-bidding. Also, I think psychologically, there's a tendency to overbid. So, in auctions, there's something called the winner's curse. So what that means is that the winner of an auction generally overpays on average. It's just human psychology, right? I mean, from a seller's perspective, that's what you want. You want people to overpay. So if you look at oil field exploration, there's normally land rights. And land rights will normally, they have an auction process. So basically, oil companies have to bid for the right to drill because they believe there's drilling, right? And what we find is that if you look at a systematic analysis of that structurally, what will happen is that on average, oil companies will tend to overbid, especially for the best oil well rights. And some companies are happy with that strategy. They just have to play to those strengths. And then they have very low costs in their search. They save money in other ways, but they focus entirely on financial firepower to find the most likely oil rigs. And then there's a group of oil exploration firms which will make their money looking for undervalued that nobody's bidding at, and they buy it cheap, but they have a better edge on everybody else. So in fact, there's a new startup that's come out. They're looking for rare materials. And so basically what they're saying is literally they're going to find metals and they're going to use their AI, blah, blah, blah. They're basically saying, we can find oil better than everybody else. We can find gemstones and, titanium and all these other stuff. We can find all this stuff better than so we're going to make sure that we always bid for underpriced bids. So I think there's an interesting piece, which is in competitive auctions, if you're overbid, you're more likely to have overpaid. So I think that's why people complain about herd effect, right? So FTX would be a good example, right? The article came out and then he was pitching to an X company, VC fund, and then he was League of Legends. And then because he raised so much money, everybody's like, wow, amazing, this guy is so smart. He's playing League of Legends, whatever. But then you take a step back and you're like, really? Is that the kind of founder you want to back? I mean, because it's showing that this guy is not being detail-oriented, right? He's not conscientious, right? He's not treating it seriously, right? And then he didn't have a board, right? So he didn't have a board of directors. So again, people were like, wow, he doesn't have a board director because everybody is so hot because it's a no-brainer deal. Let's all get in on this. The fact that he has no board shows that he has big balls and he can do whatever he wants, right? But of course, if you take a giant step back, you're like, wait, but he has no board, then there's high risk of failure, of fraud of this, because this is well known, like, every public company has a board because it turns out that if you give a person too much money and too much power, they tend to go sideways. It's like a tail as old as time. So that's what all these financial legal controls are for. So I think what I'm trying to say here is that that's why sometimes founders have something what they call a reality distortion field. Like enter that field, the bubble, and then everything sounds amazing and everything sounds great. And so that's why founders that have very strong reality distortion fields can really get a lot of bids really quickly. So the question is, in the best case scenario, going back to Visha's question, which is Apple is a perfect example, right? You have Steve Jobs, who had a reality distortion field, great salesperson, pretty good at product, T-shape. And then you have Steve Wozniak, who was really good at building, actually delivering what he had. So that would be a very good team, right? Somebody who's good at selling and somebody who's very good at building. For example, that would be a dream combo. So I think that's something to be thoughtful about. I think of Indonesia in terms of three phrases. I'll probably think about it as emerging tech market and all the problems that come with it and all the opportunities that come with it. I think the second thing I think about it is that the large demographics and economy, structural economy. And the third piece is probably some of the more Indonesia, Southeast Asia specific uniqueness to it. So Indonesia is 300 million people. There is enough people to build a large company fundamentally. So whether that's basic fundamental telco or whatever it is, you can build big companies. So I think there's that. Of course, he has all the structural macro issues that he has in terms of the GDP growth rate. If the GDP growth rate was negative, there's no startup that's going to come out from the ecosystem, right? Because if your economy is straight recession for 10 years, then obviously there's no, sort of rising tide lifts all boats. So I think Indonesia at its growth rate has those structural places. So if GDP growth rate is 5 to 6%, it's different from the Prabowo's promise of 8%. And if it's around 8%, then obviously you're going to see a lot more startups have a rising tide lifts all boats. So for example, one of the big issues that we see for Indonesia right now is that the middle class is shrinking. A lot of debate, but by their official definitions, it has shrunk by a significant percentage. And I literally told my teammates, and I was like, we have written many investment theses on the thesis that there is a growing middle class, because the growing middle class will want more consumption, will want more packaging, will want more, there's a lot of stuff that they want to eat more chicken, they want more cold chain because they want more ice cream, things that are cold. So I said, we are writing this thesis, and it turns out that by their definition, it's shrinking. So I think it goes back to the fundamental economy, right? But Indonesia is big enough, 300 million people, but I think that's the fundamental economy. So there's one. I think the second piece is that the tech ecosystem, I think it's emerging markets, and almost all emerging market startup ecosystems, good and bad, angels and VCs are stupid and they destroy value instead of creating value. Like these are all known things that happen in emerging markets, and this is going to be true in any emerging market that's out there because it's a new and emerging startup ecosystem. Whereas Singapore is a little bit ahead because it's been growing, it's a bit more history, there's a lot of influx and migration from the US and now China of these VC professionals. But obviously, Silicon Valley, which is the most competitive, the most experienced, the deepest pool, 3 to 4 to 5 generations of leadership in VCs and founders as well, like they have more professional norms. So for example, in the US, fraud exists. Obviously, we saw Theranos. There's another one, I can't remember, but this lady was Forbes 30 under 30. She also did fraud and she sold. So there's fraud, but I think it seems like a smaller percentage, if that makes sense. Versus, I think in emerging markets, we tend to see bad accounting practices, which I think are ignorance, which is, hey, they're running agriculture, so they don't know how to label contribution margin, which is totally fair. And so the job of a Singapore or US VC working with them is to make that accounting better, all the way to I've seen a lot of material misstatements of accounting because people just feel like they can get away with it, right? So I think that's the emerging market ecosystem. And now, of course, I think the third piece that I think about Indonesia, of course, is all of the various quirks of Indonesia that make Indonesia, Indonesia, right? So I think, for example, many islands that are around the place. So in the US, it's a contiguous place. So logistics can make sense. But logistics across Indonesia is really island by island. And we actually see that also in the Philippines as well. So what I'm trying to say is you can't build a land-based transport parcel system. Because in the Philippines, for example, literally, this island has its own entrenched incumbent transport system, logistics system. Then the ferry is also its own entrenched system. And then this island is this thing. And then your airport is another system, right? And so in order for you to build a logistics company instead of America, where you're like, okay, I just get this, and then my FedEx goes there, one shot. Now you're suddenly negotiating with 1, 2, 3, 4, 5 sets of stakeholders or competitors. And I think we see that in Indonesia and Southeast Asia, the island states. Obviously, there are cultural quirks as well in terms of the demography, in terms of the age profile, in terms of their faith and demographic consumer preferences as well. So, for example, I have a friend, he's working as an executive at Muslim Pro, which is the world's #1 Muslim app. And so he's here based in Southeast Asia because a very big percentage of it is in Southeast Asia and Middle East. So I think there's different aspects that make Indonesia, Indonesia, that differentiates it from, say, Vietnam, which, for example, I think there's a perception that Vietnamese parents tend to over-allocate spending towards education as a percentage because of the Vietnamese history, because of Chinese cultural Confucian teaching practices, because of communism that has focused on science and engineering, because of the current economy that gives a lot of jobs to engineers. So as a result, Vietnamese parents tend to be spending a lot more per capita than, say, Philippines, for example, in terms of education. But actually, even different ethnicities within countries actually also spend more or less on different baskets of goods as well. So I think we just have to be thoughtful about that. So I think, to me, those would be the three things. I think there's Indonesia as an economy that will be comparable to Singapore, Vietnam, America, 300 million, kind of like emerging market, ex-GDP, great growth, etc., times emerging startup ecosystem challenges, but also opportunities. Because if you can find the right company, again, because of the time travel machine, you can find a cheap deal that's underpriced and the founder doesn't really speak good English, but this guy's great, building a great business and nobody else is around. Wow, here's $5 million, So that's the opportunity of the emerging startup ecosystem, but there are also quirks for that ecosystem. So for example, you can get it wrong. So I have met Chinese founders that got it wrong. So they came to Indonesia and they were like, oh, I'm going to build it this way because the Chinese way works. And it turns out they didn't adjust for how the local Indonesian manufacturing supply chain works. And so it failed, and then they had to pivot and do something else. So, and I always remember that, the first pitch, they were like, we're going to hire 80% Chinese and 20% local. And then that company failed, right? And then the second company now, he's like, okay, now I'm going to hire 90% local and only 10% Chinese, right? So that'll be an example of because he's trying to say, like, I need to localize for the learnings I had, but I need to really localize and really understand the Indonesian market for what it is, right? So there's all kinds of other quirks, right? So Indonesia has nickel mines, which allows them to do batteries, which allows them to do EVs, but probably motorcycles and not cars, right? We're very weird. Where Singapore has no mine, no nickel, no natural resources. So it's very sad. And so Singapore is quite horrible to be an electric vehicle manufacturer because it has the worst of all worlds, right? It has no materials, no domestic populations, and so on and so forth. So I think trust is always, it would be like reliability, delivering what you promise, length of relationship. So for example, the longer you're with someone, the better your trust. If you say, I'm going to hit $1 million of revenue this year, and you deliver $1 million of revenue this year, that builds trust. So I think there's an equation that I can share with you. But I think founders will basically, obviously, if you're an 18-year-old and nobody knows who you are, it's hard to have trust. But then, of course, people tend to use proxies like, oh, you went to Stanford, and I know your parents, and you come across as very smart, but it is quite incomplete. Versus when you meet a founder who's like 43, and there's a lot of 43-year-old founders, then these guys have 20 years of experience in the workplace. Then everybody kind of knows who they are and whether they're good or not, right? So for example, we recently had an interview with Dito. Right now, he's building an electric motorbike startup called Maka Motors. He was an early employee for Gojek, and then he got promoted several times to become Chief Transportation Officer for Gojek. He built the pricing algorithm from the manual way to the whatever. So imagine this guy goes out and says, I want to build electric motorcycles. Then everybody's kind of like, yeah, I can trust you a bit more because you worked at Gojek and you're trying to build motorcycles that electric. Like it's not exactly the same, obviously, but it's closer, right? Whereas if he was at Gojek and he was like saying like, my next startup I want to build is satellites, right? Then people are going to be like, okay, I trust you as a person. I trust you that you have high integrity, but I don't necessarily know that you can build a startup, right? So I think there's that piece to it. I think if you look at Southeast Asia, they are actually all have roughly the same waves of unicorns. So for example, one of the unicorns in the Philippines is a telco, right? So Globe and so forth. I think there are two parts to it. The first part is it goes back to that time travel machine that I talked about, right? China versus Southeast Asia, right? So I think we're starting to see data center unicorns emerge in Singapore and Malaysia. These are like joint companies, basically. We're saying Vietnam as well. But I think Vietnam is emerging. I don't think they have unicorns yet that run data centers, not that I'm aware of. But the ultimate beneficial owner of this so far is like Singapore, Malaysian, probably Singapore, Malaysian, Chinese people building data centers aggressively. And so I think that we're going to see data center unicorns emerge because of this time. Vietnam is further out because they have only loosened the regulation on data centers. Previously, data centers required a lot of JVs. They were not allowed to have a certain amount of foreign ownership in data centers in Vietnam. So they recently loosened that regulation in the past 3 months. If we loosen it further, maybe you can imagine in 10 years' time, there may be a Vietnamese-only data center unicorn. I don't know, right? So I think there's a chronology piece that's for the technology ladder the Arab is climbing. Singapore does have logistics unicorns. It has Ninja Van, which is competing with China's J&T, which is also a unicorn. You can imagine that eventually there should be an Indonesian logistics unicorn, or maybe it gets eaten by Ninja Van. We don't know. But I think there's a certain ladder of tech skills that's there for that. But there are unique aspects of each place, right? So Singapore has some unique aspects because it's a hub, for example, for port. So you see a lot of maritime startups are based in Singapore. So they're doing container tracking and shipping, logistics, because the flow of trade is happening through the container. So there's a company called Podcast. I think that was in the list of the 40 startups, but they're doing container tracking and shipment tracking. So it's a good company based out of Singapore because a lot of companies have their logistics centers based in Singapore for the HQ. Whereas if you were in the Philippines, it's probably a little bit more difficult to do a maritime SaaS software targeting regional HQs, right? Versus we talk about Indonesia has nickel mines, which has given them the ability to slowly vertically integrate as a technology ecosystem around electric vehicles. And then because America is trying to reduce its reliance and Europe is being pushed by America to reduce the reliance on Chinese raw materials, they want to build or invest in Indonesia on this electric vehicle skill ladder. But the Chinese are also coming to Indonesia to partner up and JV on this because they're like, well, it's okay, we can Chinese engineers, Indonesian materials, JV, we can make it happen and we can still export to EU, for example. Vietnam obviously has an electric vehicle industry under VinFast, but they don't have the same level of raw materials that Indonesia has. So, you know what I mean? So those are the quirks that each country will have. So I guess you go to each country and you say like, hey, what are you really good at, right? Singapore is pretty bad at agri-tech startups. I met a lot of Singaporeans who say they want to do farming, but they don't really understand farming. But for example, if you look at Malaysia, Aeonic is a Malaysian agricultural drone company, and they use a lot of Chinese hardware, but they're slowly vertically integrating and getting better, building their own drones, and they work primarily in agriculture. Malaysia actually has a very strong agricultural conglomerate and plantation economy, which is quite similar to the rest of Southeast Asia, for example. So Malaysia is good at building agri-tech. It's probably a bit easier for founders to understand agri-tech than it is for Singaporeans to understand agriculture. There are some specific country-by-country quirks as well. But Singaporeans really love education tech. So there's a lot of education tech founders in Singapore. In fact, the Asia Education Tech Summit is happening in a few weeks' time and it's in Singapore. And a lot of people from now are flying to Singapore for a holiday at the same time, right? Just to, but I'll say Singapore is the hub for education tech probably across Southeast Asia, right? But there are different hubs that will be specific.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues.
We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.